All right, here we go. And let me say hi in the chat here. And we are live. Welcome, Silver Doctors Live. We have a special broadcast coming to you today. My name is Paul Half Dollar Eberhardt, and joining me from Central America is James Anderson from SD Bullion. James, how you doing today? Doing well. We got a big day today in the markets. It's FOMC day, the Federal Open Market Committee day. So there's, four things I wanted to hit on today in just a few minutes if we could. Let's go ahead and take a moment to say hi to the people that are joining us today. We've got Mark from Florida. How's it going, Mark? We got Fire Cajun 9262. Welcome. And we got about 23 watching us right now. So let's just go ahead and jump on in it. James, how does that sound? Okay, great. Well, what's going on today is we have the Federal Reserve. I call it their ritual, right? But what they're doing is they are releasing their interest rate policy statement, right? So what this is every couple of months, they get together and they decide on what they think the interest rate should be, right? So today, what they have decided on is to do nothing. So they've left rates unchanged. The Fed funds rate is going to be floating between 2.25 and 2.5, right? And it averages out to be about 2.375. Curiously enough, that's almost 50 basis points higher than the yield on the 10-year Treasury. But gold and silver had a pop here. I'm going to put that up on the screen. Let me see if you can see that one. Let's see here. Boom. So there's a little pop. Can you see that on your screen, James? Oh, okay, yeah. It should be coming. Oh, okay. Okay. I can hear you okay. Hold on a sec. Okay, now say something, James. Let me hear.
Hello. Can you hear me in the chat?
Okay, I think I probably got your audio on now. Let's see here. If someone can hear James,
Hello. Louder. Quiet.
Okay, I got it now. You should be good to go.
All right. Okay, so
just waiting for someone to give me a thumbs up.
They're saying it's really low.
No, now we're good. You're good now. It was on my end. Okay, so you should be good now. Let me know if it's perfect. Okay, you're coming in perfect, James. This is a big day, right? Wednesday at 2 o'clock, Fed released their statement. They didn't do anything on interest rates, right? Gold and silver popped on the news, right? That's something that we usually don't see. We usually see gold and silver get hit right out the gate, right? The traders call that when it hits the tape, right? When they get that fancy Bloomberg terminal feed. Gold popped up to 1360, right? It's come back down, but it's going back up again. Silver popped up to 1510. And let me see if I can show the let's see here. Let me see if I can show the okay, oh yeah, there, I got a ticker up on the screen. Curiously enough, the stock market also had a little pop there too. The Dow popped up as well. So let's talk about the FOMC statement and what was going on. They've kept rates the same, right? What are the reasons for keeping the rates the same? Well, we can go to the statement, right? And what they talk about is they're monitoring the situation, right? They, say in their statement that the labor market remains strong, right? The labor market's doing good. Job gains are solid, right? The economy's just humming along. This is what the Fed's saying, but we got to take a step back and we just got to wait and see what's going on here. As a result, this is bullish for gold and silver because, on the surface, the Fed is saying everything is great. But when you look at what they're actually doing is telling a different story. And that's saying, we're starting to get a little bit of indigestion about the economy here. Thoughts on that, James?
Yeah, I'm just looking at the Wall Street Journal right now. It says Federal Reserve officials held their benchmark interest rate steady on Wednesday, but hinted they would cut rates in the months ahead if the economic outlook weakens. So, you got to remember, in our over-leveraged system now, where central banks are literally like WrestleMania, we have to sit here like it's draft day in the NFL and talk about every stupid word that comes out of their mouths. We literally have to analyze it and try to understand what their forward guidance is for the future. Mm-hmm. So today's forward guidance, which is essentially Fed speak for tip-offs of what we're probably going to do with our policy. And some people say it's jawboning, or setting people's perspectives correctly. Yep. Essentially, what they're doing is admitting the fact that the markets are looking a little bit shaky, and we're going to be right there, ready to cut rates if things start to weaken the economy. So. Mm-hmm. It basically gives you the clue that, they're admitting the fact that we're on the cusp of a recession. And the question then becomes, well, how are they going to react? And exactly how, what are the machinations they're going to use aside from cutting rates? What other policies might they implement to stave off what could potentially be a pretty horrific downturn, given all the crazy things they've done since 2009?
Yeah. And, to take it one step further, when you look at the statement that they just released, right? One of the things that's giving them the ammunition they need to justify what their action is going to be can be found in what they just said on inflation. And what they just said was, let me pull this up here. They said, in light of these uncertainties and muted inflation pressures, right? Overall inflation and inflation for anything except for food and energy are running below 2%, right? I mean, does anybody really think that inflation is running below 2% on things other than food and energy? First of all, you gave me this really great image that I'm going to pull up here, and it's about inflation. And what I'm looking at on the screen, oh, look at there, hospital services. This is since the year 1998, right? Hospital services have gone up more than 200%, right? College textbooks, college tuitions, they've gone up more than 160%. Childcare, almost 120%. Housing, 60%, right? But they're telling us that inflation's at 2%. One of the things that the Fed uses is what they call PCE, right? Price consumption expenditures. And Jerome Powell actually said in December that they use that because they can change it every year. And then he immediately said, but that's not the reason why we use it, right? He's like, well, we prefer PCE to PCI because we can change it every year, but that's not why we use it. But, for them to say that, only food and gas, right? For them to say that, inflation is under 2%, sure. What is inflation under 2%? Clothing, right? Because of all this, it's a race to the bottom for whatever country can, sew it the cheapest, right? And use the least amount of thread to produce it even cheaper. Household furnishings. Well, sure, we're not making fine furniture in North Carolina anymore, right? We're importing furniture from China on shipping containers to Ashley, right? And rooms to go, right? I mean, that's so toys. Well, sure. I mean, does anybody even buy toys anymore? They're buying, my kids didn't want toys since they were 3 or 4 years old. They've wanted iPads, right? So anything that is like discretionary, anything that you don't buy that often, televisions, I mean, I don't remember the last time I bought a TV, but I know it's been at least 5 years. So the cover that they're using to say they're going to be patient on rates is that inflation is very low. I'm not buying it, and I don't think the audience is buying it, and I don't think that the average American is buying that inflation is that low. What are your thoughts on that?
Anyone with common sense, when they get confronted with the shadow stats situation of how hedonics adjustments have been made for inflation data, their life experience of the last few decades essentially confirms the fact that, we've been running in a system, especially in the last decade or decade and a half, that the inflation rate has been about 7% discrepancy between the truth and what they tell us. The truth is inflation on an annual basis is probably 7-8% higher than what they say. And the reason for this is simple. They want to devalue all the debt that they've been building ever since we've gotten off of the gold standard in 71. We've gotten to a situation now where the debt is just extremely large. And then as well, the promises and all the things that we've underfunded. We have to be able to somehow pay those off nominally. So in the end, the Federal Reserve, they're going to want inflation, and they're going to want to do it in a way where people don't reject them outright. And to do that, they're going to have to lie consistently about what the true inflation rate is. They've been doing it for decades, and they're going to keep doing it for decades in the future.
Mm-hmm, mm-hmm. And, when you look at things like housing, when you look at things like the stock market, that's the other thing, right? There's tons of inflation in the financial assets as well, right? Yep. And what does that bode for millennials who are, debt laden with student debt, right? And they want to buy a house. How are they going to buy a house? Housing prices are going nowhere but up for the past 10 years. So, it just, to me, it stinks to high heaven because it's like a punch to the gut, right? Because they're in their ivory tower, as they like to call it, right? As the analysts like to call it. They're in their ivory tower talking about there's no inflation. Well, sure. They're not, feeling the effects of everyday consumer items like the average Joe does. So there's definitely a disconnect there with academia and with Washington in general with what's actually going on with prices at the street level.
Yeah, if you think about in terms of who are the mouthpieces that are giving off the perception of reality, most of those people are people who are benefiting from the system as it is. They're the ones who are closest to the trough of the currency creation and credit creation. So they're going to enrich and engorge themselves and tell you things that aren't real, tell you things that aren't reality. And that's where we are. Most of the mouthpieces that we hear, unless they're alternative news, like folks like us who are getting shut down in various ways, they're just going to keep telling you lies and lies until you stop believing them, or you just go along with it, and that's a road to real perdition if you keep going along with what they tell you and believing it.
Mm-hmm, mm-hmm. Another thing, changing topics slightly, still keeping focused on the Fed. Jobs, right? That's the other big thing. Mm-hmm. The Fed has two official mandates, and those mandates are stable prices and full employment, right? That's why they don't say 2% inflation is a mandate. That's why they say it's an objective, because technically the mandate is stable prices. But when it comes to, and we already know they're not stable, and we already know that inflation is not muted. But when it comes to the job aspect, it's interesting too, because they're saying that the economy is strong. They're saying that job growth is solid. But I don't know if this is the longest expansion in history or if it's, either way, we're like right there. So this is what happens at the very end of a cycle, right? So it's as good as it's going to get right now, right? But this means that it's going downhill from here, right? So, that, interestingly enough, when you talk about muted inflation expectations and when you talk about solid job growth that's going to start turning down, that's going to add additional cover that they need to start cutting rates. So the big question is, we've got a question here in the chat. Did they cut? No, they didn't cut. They just held steady, right? But the market's starting to think that they're going to cut, right? In my article today, I put up this chart. Like CME Group has this probability where they were calculating, I think it was a 17.5% chance of a rate cut, like a 70 or like an 80 something % chance that they would hold, which they did hold, 0 chance that they would have hiked, right? So the market's already starting to prepare for these rate cuts. And I'm probably jumping around a little bit in here. But my point with that there is if yield on the 10-year note, right now is like 2.08 or something like that. I'm going to look right. 2.04% on the 10-year note, right, which is almost 50 basis points lower than the Fed funds rate. When they cut rates, a 25 basis point cut is not going to do it. A 50 basis point cut is not going to do it. They might need to go all the way straight to 0, because here's the other thing. You're already inverted at several places on the yield curve. And on top of that, you've got a consumer-based society where the consumer is already tapped out, right? So just because you have access to more credit, that doesn't mean you can actually buy more stuff because you're tapped out. You know what I mean, James?
Yeah, the interest rates, we saw what they did as they climbed to the end of last year. Remember December 24th when Steve Mnuchin was on vacation down in Mexico somewhere, and the markets were full on going and catching on fire. They were dropping precipitously, and he had to have an emergency phone call with the heads of the banks, and Lord knows what types of plunge protection team machinations came out of it. But obviously the stock market rebounded and came back, and here we are again near all-time nominal highs for the Dow and S&P. So whatever they did worked for the short term. Maybe for the medium term it could work, but on the longer scale, the Fed's literally sitting in a situation where it's you raise the interest rates any further, the stock market explodes, financial assets start falling, and you could have a real situation where you have a run on give me my money back, essentially, is what you get if you have asset prices falling. And when you get a situation where everyone's asking for their money back, that's a real problem. That's essentially 2008 type stuff. So they're going to do whatever they can, it looks like, to accommodate these bubble financial asset values that we currently have. And they're going to try and prop them up and let the air out slowly but surely. That's my hunch. That's probably where we're headed toward, where you will have a structural bear market in stocks and in even bonds and even in real estate for the next decade or so, while commodities are allowed to levitate and inflation is allowed to dispense with some of the overhanging debts and unfunded liabilities that we have currently in the United States.
Mm-hmm. That's right. And for the people in the chat, or people tuning in, right, or people joining us on Silver Doctors, what James is talking about is, there's basically three ways that you can pay off a debt, right? You can pay it off by defaulting on it, right? That's just, I ain't going to pay that, right? I mean, that's a way you can pay off a debt, right? Just not paying it. You can renegotiate the terms, right? Which is essentially a default. Either of those cases, right? That's it for the dollar, right? The dollar's done. So that's not the expedient thing to do, and it doesn't have to be the dollar, right? It would be any of the nations that are in this debt problem. So it would be whatever that currency is. In this case, we're talking about the dollar. But the other way that debt can be paid off is you can inflate it away, right? So if inflation is running higher, right, and that debt is at a fixed rate, right, that becomes much easier to pay off because, theoretically, right, as your inflation rate is running higher, well, so is your income, right? So you have more income coming in and you can pay off that debt faster. I don't know if I'm missing any of those points there, but inflating the debt away, that's definitely real. And that's what happens, I would say, 9 times out of 10, because that's how we know that 10 times out of 10, because that's how we know fiat currencies die, is through that hyperinflation, which is what inflating the debt away amounts to.
One point on that, Paul, it's not always that route. It also can sometimes be a political restructuring where you have a meeting and you have a rejiggering of prices based on some new monetary system, some new model. My hope is that's essentially where we're going. I definitely don't hope or pray for hyperinflation, because that, if we keep down this road and keep down this path, essentially you start breaking the confidence boundary that people have in the currencies that we spend our lives working for. It's just absolutely ludicrous that we go out day in, day out, spend our precious time on this one go round of Earth. No one's promised anything more. No one knows for sure what's next. And we sit around and we get these pieces of paper that we all agree have some type of value. Well, when that gets broken, real problems start occurring. And if you look at historical examples of all the various ways that this goes, they're always ugly. It's always an ugly situation. And we are now sitting in a place, we've never done it on this grand a scale. And so the question is, well, the repercussions are going to be grander than anything we've ever seen in terms of human history.
Yeah. And, my thoughts on that are, you're right. Exactly. What you're talking about would be essentially what people call like a reset, or a like a debt reset or a monetary reset or a currency reset. And we do see those from time to time. My thoughts on that are, it's going to take a crisis before we get there, though, right? Because, they're not just going to say, well, this debt's out of control. Let's just kind of get together. So, either way, I think that whether we get the hyperinflation path or whether we get the restructuring path, either way, there's going to be a crisis before and during and as that's happening. James, we have one of the docs running Silver Doctors in the live post that we've just unleashed some new features today. So let's go ahead and take a second to address a little bit of the chat here in YouTube. Let me scroll through a couple of these questions here and see what's going on. We got Harvey Birdman, a Stacker AG. Thanks for turning in. Silver 1513. Nice. It's looking good. Looks like these metals want to run here. It's funny, too, because we talk about a knee-jerk reaction, right? And oftentimes the knee-jerk reaction is, what happens right as soon as the news hits the tape? Boom, it's a knee-jerk. 9 times out of 10, it's hit the metals and the metals plummet. But the interesting thing about right now is, especially with silver, I'm looking at this chart. Let me pull this chart right back up here. This is the silver chart right here, where my cursor is over. But I'm seeing 2 higher lows as far as a technical picture. Silver looks like it could break out, as we're speaking. And as we're speaking, Jerome Powell is speaking, right? The press, the mainstream media is teeing up all these. They're not even pitching softballs, right? They're literally teeing it up, and he's walking up and swinging at these questions because no one's ever going to ask him any real questions or any hard questions, right? But, there is the potential for these metals to run, and the knee-jerk reaction is indeed the direction of the move today because of what it's looking like on the technical tick by tick, right? I don't know. I'm into following the tick by tick. I think it's fun sometimes, but it's nice to see the knee-jerk reaction and then follow through. That's my point there, and it looks like gold and silver want to have some follow through. We've been testing 1350 several times all day yesterday. We were trying to break through it. We couldn't get it. Silver was testing $15 all day yesterday. Couldn't break through. Looks like we're finally breaking through those levels right now, though. So that's some good news there. Let me see what else we got going on in the chat. For debt, consumer goods. Oh, that's SD Boyan. Okay, let's see here. Fred Gar, if you don't hold it, you don't own it. That is my feeling right there. And that's funny too because is when there is excitement coming back in the sector, and we know it's coming, right? Because right now the only things that are undervalued are the commodities and gold and silver, right? And when excitement comes back in, I lost my train of thought there. Oh yeah, when excitement comes back again, there's so many ways that we've got it set up, right, to try and maintain the perception of normal markets with all these ETFs, right, with like the GLD, with like the SLV, with futures contracts. There's all these different ways that people think that they own gold and silver, but really they don't own gold and silver. And, when push comes to shove, right, and these metals are really taking off, guess what? Those terms and conditions are going to change, So if you think that you have gold or silver and you really just have some sort of ETF that's in a brokerage account that you can double click online, that's not the same thing as holding it, right? And that's true. If you don't hold it, you don't own it. Your thoughts on that, James?
Yeah, I think it's more nuanced than just simply if you don't hold it, you don't own it. I agree. I think first and foremost, when you're getting into precious metals, owning bullion firsthand outright is probably the safest bet because you can definitely count on yourself more so than perhaps others. But it gets more complex if you get to say 6 figures or some amount of money that you don't necessarily want to have in your house without any insurance or any safety other than, worst comes to worst, someone home invades you with a gun to your head. I'll choose my life over my bullion any day. So you have to think a little bit more nuanced with how you hold your bullion and who you hold it with. In terms of derivatives or ETFs or any of that stuff, I still am of the opinion that what we saw in 2008 with retail gold shortages and wholesale gold shortages and retail.
And we got a drop here. Should be reconnecting shortly. That's the beauty of a live stream across different countries. There you go. Okay, you're back with us, James.
Okay. I don't know where I got cut off there.
Okay. It looks like our stream. Okay, looks like our stream is back up. Looks like we're back good. Mm-hmm. Okay. Give us a thumbs up in the chat if we're still good to go here.
Yeah. Okay. So I think I'm going to just keep going with what I was saying. You were asking about if you can't hold it, you don't own it, or if you don't hold it, you don't own it. Those are nuanced expressions. If you don't hold it, you don't own it is the ultimate paranoid mantra. And I understand that. I can totally agree with a lot of that sentiment. First and foremost, when you're getting into precious metals, having bullion directly in your hand outright, owned under your own possession, is probably the safest play. Then as you get a larger percentage or a larger amount of bullion, you might want to think about some diversification in terms of where it's held and who by whom. You better know who's holding it and how solvent they are and how trustworthy they are. In my experience, I've always trusted, companies that have been around for hundreds of years, like Brinks, or I trusted Loomis. I personally trust Loomis with a lot of my precious metals. And there's a lot of people who are of the opinion that not only should you have it domestically, but perhaps too internationally. Look, in the end, it all comes back to you have to trust some people. If you start to get a really large position, you not only have it under your house, but elsewhere. In terms of derivatives, I'm still of the opinion that 2008 was just a foreshadowing of what we're going to see in the future, where we had wholesale and retail limited supplies of gold, very difficult to find. There was days in 2008 where I was literally on the front lines selling gold kilos at a spot price of $7.30 for about $9.30 an ounce, right? So $200 premium on a gold kilo. And, in percentage terms, that's something like 40% over spot. Now, we don't have graphs that I could prove that for you, and I did document it at some point, but the internet has since erased it. So, but there are graphs and data documentations that you could find for silver eagles and gold eagles performing extremely well in that situation. So, yeah, you could sit in derivatives, but the problem with sitting in derivatives is you don't get that premium when it comes time to potentially sell or offload a little bit of your position when the premiums get stupid like they did in 2008. For instance, in 2008, if you had a brain and you had silver eagles, what you should have done was sell silver eagles at $16 per ounce, turned around and bought some generic 100-ounce, 1,000-ounce bars for $9 or $10, and just sit and wait until the premiums come back in line, and then rebuy your silver eagles if you like. You'll end up getting a few more 100 ounces, if you sold, say, 500 or 1,000 at the time. So it's just a little arbitrage play that you can do, but you can't do that stuff with derivatives. Derivatives are just, they are what they are. They're good for day trading. Good luck if that's what you're doing. But in terms of like a safe haven or a flight to some safe place when the financial system's going wrong, you need to rethink that. That doesn't work.
Well said. And you're right. I totally missed the point about, being diversified, and that is important, right? It's funny because, sometimes I would rather drive all the way across the country than fly, but, to each his own, right? And I think you're right. My stack is very humble, so I don't have stuff all over Singapore and Hong Kong and Canada and the United States. But anyway, yes, once you start getting those six figures, you're going to want to be diversified in more ways than one. Moving on, I want to get back to the interest rate policy again, because there's a point that I want to make, right? And one of the points that I want to make is the yield on the 10-year note has been dropping, right? And it's at 2.04, whatever I just said it was. But here's the thing about that, right? What the common wisdom is that the markets are anticipating the Fed rate cuts, right? So the bond market is pricing that in, right? But here's the thing, right? Gold and silver have not yet started pricing in these rate cuts, right? So, I think that we're going to see some turbochargers put under the prices of gold and silver. Once it becomes clear that the next move by the Fed isn't going to be just a hold anymore, right, but is going to actually be a cut. Because, that could be why we're starting to see those initial movements of it right now, right? I mean, sure. I mean, there's obviously the fundamental factors going on. There's the whole buildup and the uncertainty around what's going on with Iran. Other factors like that. But just in and of itself, the market's already beginning to price in rate cuts when it comes to the U.S. bond market. We're just now starting to see those pricings in for gold and silver. So, one of the things that I wrote about this morning was, with the gold to silver ratio at 90, and with silver at $15, these are coming up on those times where it might be hard to see these prices again for a while if they really start breaking out here. And I wanted to just hit real quick on why that is the case. And why that is the case is because as interest rates come down, right, one of the reasons for moving into gold and silver is the fact that as interest rates come down, right, lower than the level of inflation, right, that means that you're not keeping up with inflation, right? But theoretically, if you own gold and silver, you are keeping up with inflation. So where the argument goes that, don't buy gold because it doesn't pay any interest. Well, it's keeping up with inflation, right? Better than those super low yielding bonds. So that's one of the factors there. Any thoughts on that, James?
I mean, interest rates are already lower than inflation. We've already talked about how much higher inflation is than interest rates. And that's what real negative interest rates are. It basically means that you're losing if you have any type of instrument that's paying you, say, 2.5% per year. Now, that's been masked in the last few years because the dollar has been stronger versus the emerging markets. So you got a lot of people running around, owning bonds, thinking that they're the kings of the world. But I think they're in for a rude awakening when we start to let the inflation genie out the hat, because that's ultimately what we agree, I think, is the Federal Reserve is going to do. They're essentially going to allow for price inflation to really start to take hold. And that's going to be very negative for financial assets, at least in their values. They're going to do it in a controlled fashion, or at least they'll try to. Question is, are they going to be able to do so in a controlled fashion, and how long will this go? And my hunch is it's going to go for a while. It's going to go for as long as it takes for the baby boomers probably to die off and us to come back to a sense of reality in terms of what things are really worth. Mm-hmm. And in the meantime, I'm going to continue to hold real things and lean on things that have worked for human beings for 5,000 years, whether that's food or precious metals or other things that we consume on a day-to-day basis that we completely undervalue currently.
Yeah, and I actually think that one of the things that nations are going to do is I think there's going to be a move into copper, actually. So exactly, things that you can own, things that you can hold, food, real things. And that's one of those things that you can stockpile super dirt cheap right now, along with gold and silver, obviously, too. So let's get ready to wrap it up here in a few. Maybe let's address a couple more questions here in the chat, and then we'll call it a day. Does that sound like a good plan there, James?
Yeah, Paul, I see a question about the Libra, the Facebook Libra, and it's pretty funny. I was looking at the Libra the other day, and I didn't read the white pages. I just saw some of the headlines about it. It's pretty interesting. The Libra originally was the precursor to the British pound sterling. The Libra was defined by a legitimate amount of money. Now it's just something that Mark Zuckerberg and friends just create out of nothing to try and hold some semblance of importance and relativity. I guess it's backed by fiat currencies, so it's essentially like an IMF SDR without the yuan. And anyone who's ever looked at how the IMF SDR has performed since 1969, it's lost 90 some odd % to gold and silver since its inception. So if that's the last 50 years, what do you think the next 50 years are going to look like?
Mm-hmm, mm-hmm. Yeah, exactly. And a couple more points. I mean, there's just so many points that you can make, but a couple more points, terms and conditions can change on that, right? They're the ones that are in control of it, right? I mean, an ounce of gold or an ounce of silver is an ounce of gold or an ounce of silver around the world. The Libra, that's Facebook's, and that's theirs under their control, right? So, I mean, I don't know. There's just so many ways to look at that.
Yeah, when you talk about privacy, which I don't think people are valuing, they don't value privacy like they don't value real goods, services. They don't value commodities. They don't value precious metals today. Eventually they will, and you want to be ahead of that.
Yes, exactly. Well said. Couple more questions here. Someone else, Blaze Frogs, is saying, yeah, they like the idea of copper. Remember, folks, all things prophetic. Remember, folks, precious metals are excellent, but in relationship, but a relationship with. Oh, okay. It was spell check, right? But a relationship with God and to be kind and helpful to your neighbor is just as important. Yeah, right, because ultimately it's about community. And, we're trying to fight the good fight, right? And part of that good fight is honest money, right? And what is honest money? That's God's money, and that's gold and silver. So well said there, all things prophetic. Don't trust Facebook. Don't trust Facebook.
In our pre-live video discussion, I mean, it's God first, your family, your friends. Those are the things that matter the most. Obviously, precious metals are going to help you along the way, and other undervalued assets that you may buy now. But ultimately, it's your fellow human beings, the ones closest to you, that matter most.
Mm-hmm, mm-hmm. Yes, it is. Okay, so we're getting ready to wrap it up here. So today, we got the Fed to hold, which was no surprise to anybody. We got the Fed talking about how they're monitoring the situation, which was no surprise to anybody. And we got the market participants thinking that the next move is going to be a rate cut. I think that before they cut, I think the stock market's got to come down a bit. I mean, we're right back up to record highs again on the Dow. I really don't see how, if the Dow makes a brand new all-time record high, how they're going to cut rates into that. I mean, is the American public that gullible? I mean, we might just be, right? We might just be. But, it makes no sense to me. So I think that if there is a rate cut coming this year, then there's got to be some sort of, stock market's got to be dropping, unemployment's got to be kicking up, and there's got to be some problems going on in the economy. Because, they're saying it themselves, right? The economy's strong, inflation's muted. Well, that's their excuse, right? But, so those are my closing thoughts there. Stock market's at record high, but still gold and silver look like they want to run. What are your closing thoughts there, James?
It's just the status quo that we've been hanging around in the last few years is going to go away at some time. Before people realize it, it's just going to happen overnight in some way, some fashion, and we're going to be on the other side of the hill going down fast. So you just have to be prepared for that and psychologically get ready for that, because we're not that far away from that day.
Well said. Well said. Ladies and gentlemen, we are going to be bringing more live streams, more content, more interviews. We are really kicking up. You might have seen a little bit of behind the scenes work here, and we're taking it up to the next level. So I would like to thank you all for tuning in, for participating in the chat. James, I'd like to thank you for putting you on the spot and joining us from Central America today. I know you've got a lot going on. And everybody, thanks for tuning in. Be real. We'll see you next time. As Mike would say, peace.